Hi everyone. Today we're going to be talking about dollar cost averaging and how that works with your investments. Welcome to my financial literacy channel, where my aim is to empower, inform, and provide the agency to support Canadians from negatives to millions. You can find out more or connect with me in the links below. So, what is dollar cost averaging? Dollar cost averaging is the idea of purchasing into your investments over time on a fixed dollar amount rather than a number of shares. Usually, when you talk to regular traders, or if you're dealing with things like ETFs, your own shares, even mutual funds, what you end up buying is a certain number of shares. For example, one share of Tesla, one share of Apple, one share of Microsoft, or whatever it happens to be. Now, if you're dollar cost averaging, instead of purchasing a single share or a single unit, what you're purchasing is however many units your fixed dollar amount will buy. So the whole goal of dollar cost averaging is to decrease your volatility. You don't have to try to time the market. You're not attempting to buy something at its lowest cost or its highest cost. At the end of the day, you're just kind of consistently taking out the emotional component of investing and just putting the same dollar amount in on a regular basis. So this allows you to basically build a portfolio over time, again, without trying to guess or time the market. In order to dollar cost average, most investment advisors or investment firms or even online institutions will allow you to automatically make contributions. So this means maybe setting up $500 a month, $25 a week, whatever it happens to be, so that you're regularly buying into the market. The best way to think of why dollar cost averaging works is imagine buying a pair of shoes, all right? Now, this is going to be a bit of a silly example, but let's say you buy one pair of shoes for $100. The next week, the same pair of shoes is now only going to cost $50. So with your $100, you're going to buy two pairs of shoes. Now, the week after that, these prices have doubled and now you're $200 for a pair of shoes. Well, since you're still putting in $100, you're going to buy one shoe and not two shoes for the same price. By doing this, as I said, you're taking out the guesswork in terms of timing, and you're just purchasing however many shares are available at that time to you on that dollar basis. The reason this works over time is it allows you to purchase a higher number of shares when prices are lower and a lower number of shares when prices are higher. So again, you're not guessing and you're just accumulating shares on a long basis. This works really, really well in volatile markets like we're experiencing right now. Because when things go down, you're buying more. When things go up, you're buying less, automatically almost timing the market without timing the market. This is an excellent strategy that can not only be used for your regular savings, but also whenever you're making lump sum contributions. So, what I mean by lump sum contributions is let's say you get a pension windfall, let's say you get an inheritance, maybe there's a big bonus that comes through, and you're nervous about when to put the money in. Well, the best thing to do is literally to break it up and try to dollar cost average. So this means that you would be making a contribution once every month, once every quarter. Let's say it's $100,000. You divide that up into 12, and then you're putting a lump sum in every single month. Again, you get to take advantage of the market no matter what it's doing, and you're not over purchasing when the prices are high. Now, this does have some downfalls in the sense that obviously, if the prices are dropping on a consistent basis, that means that your first lump sum would have purchased less shares than your later lump sums, and you're going to see a decline in value in your portfolio. However, what I'd like to remind my young investors out there, and literally anyone who's holding on to their investments for really a period of like 7 or more years, is that the market cycles will eventually work in your favor. And by purchasing all of these share units while the market prices are down, you're going to have a whole bunch more in your investment portfolio when things recover, because instead of having 100 shares of something, you have 1,000 shares that you've built up over time, and all of those increase in value at the same time. Now, on the other side, if prices are going up over time, obviously you might feel like you missed out by putting everything in at a certain, like at the lowest price. Now, that's just natural FOMO. All humans experience that. All humans wish that they had been able to time the market better. It's really not possible to do. I mean, really, there's so much research out there that shows that some of the best investment advisors on Wall Street have been bested by monkeys making random decisions. So please don't think that you can do this any better than you can randomly. So for this reason, dollar cost averaging protects you and your portfolio over time. Now, what happens to all of you who don't have consistent income? So you're not on a salary, maybe you're self employed, maybe you're a consultant of some sort, and you just get lump sums of money. Well, you still want to try your best to dollar cost average. So, as I was saying before about the lump sum windfalls or inheritances or whatever, you kind of want to apply the same principle. If it's a huge chunk, a huge check that you're getting, you might want to spread it out over time. If we're talking about peeling small amounts off of your regular income, like maybe you can get away with $500 one month, maybe you can get away with $1,000 the next, maybe it's only $100 after that. You take each one of those and you just put them in the market when you can. So, your best advice, honestly, is to speak to an investment advisor or a financial planner so that you can determine what strategy works best for you. Now, if you are invested through an online brokerage where you are responsible for direct investing and you're the one who has to purchase the shares yourself, your institution is not going to automatically invest for you. So you can set up automatic contributions to go into a TFSA, for example, and every once in a while you're going to have to turn around and make sure that you invest that money directly into the investments you're intending to purchase. Now, the last thing I want to mention about dollar cost averaging is that this actually works in reverse as well. So, if you are in a position where you are starting to withdraw income, maybe you're retiring, maybe you need to take money out for mat leave or something like that, the same principle applies where instead of being forced to sell at a certain fixed price, you're selling over time. This helps to reduce something called sequencing risk, which is where you may deplete your resources by more than you intend to by taking out a large lump sum at a certain period of time. This is caused by the fact that your shares, your individual shares or your individual units may be priced at a lower point, and you need to withdraw more units in order to meet your dollar amount requirement. So by spreading this out over time, you allow yourself to keep more in the market in general rather than taking out a huge lump sum and living on that. You can protect your investments as best as possible while still feeding yourself if you need the cash. The same is true if you are planning on a large purchase or a large withdrawal. So, for example, if you've been putting away for some time and you intend to buy an investment property with like $100,000 that you've put away, again, unless the markets are super favorable, which you can never perfectly time them, but you can always talk to your investment advisor or financial planner about this, then you can again start slowly but surely planning for this. And maybe instead of making one large sale of 100 grand, you sell off $2,000 at a time, $5,000 at a time, and slowly but surely build your way up to the cash that you need in order to make your purchase. At the end of the day, dollar cost averaging is a tried, tested, and true method that almost every investment advisor or institution will swear by, usually. There are, of course, some limitations because you can't time the market perfectly, but in my opinion, that is the exact benefit to dollar cost averaging, is you're not trying to time the market. And my ultimate advice anytime you're investing is to do your best to remove the emotional component so that you are just working consistently and investing consistently without trying to best anyone or best the market, because at the end of the day, you don't want to be gambling, you want to be investing. Now, I hope this video gave you some good insights. Please don't forget to like, subscribe, or comment for more about your money. If your questions are larger than the contents of this video, don't hesitate to reach out to the certified financial planner in your life for more professional support. Or you can contact me by texting, emailing, or setting up a 30-minute phone call in the links below. I am currently taking on new clients, and I am always happy to help. Until next time, wishing you financial security and success.